Good afternoon. It's Saturday and we're talking about money here. And our theme today is based on a book by Anna Duke. She was a professional gambler. It's called Quit. And I guess a better way to look at it would be from the Kenny Rogers song, is I guess to know when to hold 'em, know when to fold 'em, know when to walk away, and know when to run. And of course, we're not just talking about gambling, we're talking about your investments. And it's kind of an interesting week to talk about it. Because for the second time in his career, Tom Brady's thrown in the towel. He decided to quit. He's a guy still playing at a really high level. And it's interesting to look at sports figures who when they quit. Most of them wait till they're just useless paperweights and just rag dolls, and they decide to limp off the field. But he's leaving at a still a really capable quarterback. It reminds me of another guy, because I know Mike is a real big baseball fan, and me being a Red Sox fan, when David Ortiz quit. Mike, do you remember that?
I remember.
His final season in 2016, I want to read you this numbers, because I think we could probably use him in the Mariners' middle lineup. 38 home runs, 169 hits, and a .315 batting average at the age of 40.
And that's his last year.
Last year.
First ballot Hall of Fame.
Can you
Almost for sure.
Can you imagine walking away with those numbers?
Oh.
I mean, but good for him, right? Walking away without batting 167, with 42 hits and 20 RBIs and one home run, right? I mean, he he went out on top.
Remember Willie Mays?
He was a little before my time, but he always thinks up before my time, but go ahead.
So Willie Mays finished in San Francisco and then went to the Mets and played a season or two.
Yeah.
And had terrible season. I mean, one of the greatest baseball players of all time went beyond his time. His time was up. But he went to the Mets and had a couple terrible seasons.
Yeah, yeah. And I remember when I was a kid, my dad was a big boxing fan, was Larry Holmes in his last few years, the champion. He was a great fighter in his prime, but you could see when he came out his last 2 or 3 fights, and he was punching around the middle, and he wasn't as quick, and he just got dusted. And the guy just stayed in the ring, won too many fights.
I remember Muhammad Ali.
Yeah, yeah.
I mean, incredible fighter. Dance like a
float like a butterfly and sting like a bee.
That's it. I mean, in his early days, even when he came back after being in the Army and being gone from the fight game for 10 years, he came back, everybody assumed he was going to just be meat. Mm-hmm. And he came back and won his fight, won the heavy world championship, and then continued to fight, and it went down. Mm-hmm. And people began to say he looked like he was dead.
Right.
He continued to fight, and it just was worse and worse and worse.
Yeah, yeah.
I mean, that was the theme of the book Quit by Annie Duke, is you need to know when to quit.
Yeah, I mean, and I read something this was from the Harvard Business Review, talking about, same thing, when to quit. How long should I stick with, they were talking about jobs, or stick with anything. But, they keep into the sports theme. They compared it to minor league baseball players, Baseball players, and this is their quote here, baseball players on a minor league team, the players often receive low pay for little job security, but live in the hopes of being spotted by a major league team. Only 11% of those will transition. 89% are left to languish.
Yeah.
And not only that, Mike, they go on to say that it can also be detrimental to your health to hang on to something. And for us, we're talking about people who hang on to their investments and hang on to maybe trying to be a do-it-yourselfer, even though we've talked to people, right? You and I have talked to people who have hung in there, and you ask them, well, how are you doing with that? Well, not so good. Well, have you had a good year? Well, not really, but I really want to do it. Okay.
And it works not just for people. I mean, Annie Duke pointed out the Tom Brady example.
Yeah.
That when he played in his first Super Bowl in 2002, the companies that bought advertising, 80% of them are gone. Mm-hmm. Mm-hmm. I mean, they had enough money to do advertising for a Super Bowl, the millions of dollars it takes for a 30-second ad.
That's my new, we get to know when to hold them, fold them, walk away and run. That's my run, right? When I saw If they had an ad at the Super Bowl, like FTX 1999 when all the .coms, right? That's when you run.
Absolutely.
So, yeah.
No, that is the theme we want to talk about. Know when to hold them, know when to fold them, know when to walk away, and know when to run. I think almost everyone has had a stock that they buy, it goes up. They fall in love with the stock, it goes up, and then it peaks, and then it starts down, 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 and you end up with a loser. I think most people have experienced it. I have. Mm-hmm. I hate to admit that. I have done that in the past, but it's happened.
It's happened to the greatest, the best of them all. It's happened to.
Yeah, and ups and downs are part of the stock market. I like to relate the story of Peter Lynch, because Lynch averaged 29% for 13 years. It wasn't 29% per year, year after year after year. Some years it was 40% up, and some years it was 40% down, 50% up. And we have a client who actually lost money investing several times with Peter Lynch. He would wait until Peter Lynch was up, buy in, everything was going well, he would have a good time, and then when it dropped and he was at a loss, he would sell out. So he'd lost money with Lynch, only to see Lynch, the Magellan Fund, rise again, to buy in again, and then sell again at a loss when it came down again.
You know who that's happened to right now? Cathie Wood.
Yes.
There was an article in Barron's about her, and a couple other investors were trashing her, well-known investors, and they said that they see the peak of people buying in when she's doing well and then selling out when she's in her philosophy is just like us. She's like, well, I think people want a consistent philosophy, but people want to buy in only when people want to buy in at the top.
Yes. They want to buy in when they feel good.
Yeah, like we're experiencing right now, right? Is that people with going up, but people still want to hesitate. Like, well, okay, they're going to wait till they see proof. Okay, what's proof? When you're up 40, 50, 60, 70%? What's proof that things are working?
Well, and the reality is the very best time to buy in is when you're so scared that you're hanging onto the edge of your chair and your knuckles are turning white.
Yep.
Because you're thinking everything could go down. And if there is a little glimmer of hope, you wonder if the light at the end of the tunnel is the train coming.
Yeah. Those
are the best times to buy. Mm-hmm. But if you're involved, if you're in it, it's knowing when to hold them. That's going back to the Kenny Rogers, know when to hold them. Mm-hmm. And, we talked about sports figures, but you can take it to other places as well. Albert Einstein, I've used him on the radio program before. I mean, when he graduated from college, number one, when he was in high school, his high school principal said that he shouldn't go to college in the first place.
Yeah.
Because his mind was so distracted, he couldn't stay focused on what was going on in the classroom.
Right.
He did go to college. When he graduated from college, he wanted to become a physics professor and got turned down by every single college. The only thing he could do was go to work for the Postal Service. And there he wrote a couple essays about E equals MC squared, light and mass. Mm-hmm. And Time magazine picked him as the man of the century, of the last century. But he couldn't even get a job as a physicist until he had written those articles, which were revolutionary. Oprah Winfrey had a child at the age of 14 and ran away. Vincent van Gogh, they had the exhibit in Seattle. During his lifetime, he sold only one painting, and he didn't sell it for that much. Stephen King was turned down 30 times when he tried to publish his first book. Jack Canfield, I went to a seminar once where he was speaking. He was rejected 26 times for Chicken Soup for the Soul. 7 of the books became #1 sellers. Mm-hmm. But 26 times publishers turned him down. If you look, Winston Churchill, Abraham Lincoln, Bill Gates, Thomas Edison, you can go on and on for people that overcame difficulty and moved forward. There's something to say to know when to hold them, part of the story. And when people have a financial advisor, it's hard to make a change. There's plenty of quit, Lynch and Buffett. How do you make a decision? We're back to Kenny Rogers. Know when to hold them, know when to fold them, know when to walk away, and know when to run. I think that's a really critical decision. And we're at one of those points right now where it's time to know whether to hold them, to fold them, whether to walk away, whether to run. That's if you think you're in a scam. But certainly, it's a time to know whether to hold them, whether to fold them, or whether to walk away. When we come back from commercial break, we're going to talk about some of the reasons. And we're also going to talk about a letter that I just received yesterday from a competitor who said, you shouldn't publish your numbers. He doesn't publish his. Why should I publish mine? We'll come back and talk about that one as well. It's a funny letter. You know, that's the theme for today. Know when to hold them, know when to fold them, know when to walk away, know when to run. It works in poker. It works in investments as well. And we feel that we're at a really critical time right now. Almost everyone has an account that's down. Ours are down more than most. We recognize that. We know that. We've been there before. That's okay with us. We're going to be down sometimes when other people are up. How do you know whether to hold them or whether to fold them? I think it goes back to the track record. And yes, we're always forced to say past performance is no guarantee of future results, and that's really true. But what else do you really have to judge? You know, when I worked for big brokerage firms, they said, sell the relationship, not the performance, because they want advisors to be very liked. They want clients to really, really like their advisor. Regardless, even if they're getting crappy results, you know, if you like your advisor, you should stay with him. That's what the big firms would say. Don't worry about how you're doing. You know, you may end up selling popcorn at the baseball games or selling hot dogs at the baseball games, but at least you have an advisor that you like. It reminds me of a cartoon that was in the Wall Street Journal back in 1987. It showed an elderly couple sitting at the desk of a financial advisor, called a stockbroker in those days. And he was telling him, well, you lost $50,000, but I made $50,000 in commissions. So I guess we broke even. I wish I would have cut that cartoon out of the paper. I really do. I've thought about it so many times. That is the philosophy of the big brokerage firms. You lost $50,000, but the broker made $50,000, so I guess things are equal. No, they aren't. You should be making the money. That's where it comes down to. So the question is, if you're going to hold them, you have to look back at a track record. And for most people, the only track record they have is their own account. For our clients, they can look at a published track record. We publish our record. We publish it from the time we started Adams Financial Concepts back in 2005. We publish it from the downturn in 2009, where we hit a bottom. And we're about to do that again in 2022 because we think we hit a bottom on October 12th. But you have to look at the track record. And there's reasons now to walk away. There are real reasons to walk away. You know, we've just come through COVID, and we talked before about how COVID is the Pearl Harbor moment of our lifetime. Things have truly changed in terms of technology and demographics and lifestyles. And if you add to that what's happening with inflation, think about this, and we've talked about this before. The Fed is looking not at the CPI, but at the personal consumption expenditures. That's how much you're spending on groceries. That's how much you're spending on gasoline. That's how much you're spending on going out to eat, how much you're paying for clothes. The Consumer Price Index has a lot of other things, including healthcare. They have housing in there, an equivalent of what you'd be paying if you're renting rather than owning your home. All of that's built into the CPI. The Fed is looking at personal consumption expenditures. And if you look at what's happened over the entire year, 2022, PCE, the personal consumption expenditures, has hardly gone down at all. It was down 0.2%, from 5.2 to 5. That was the last Fed talk. The question is, will it get down to 2%? And we don't believe it's going to happen in a very short period of time. We believe that beginning with the Obama administration, continuing with the Trump administration, going through and now with the Biden administration, There's a huge focus on creating jobs. And all three administrations have done a very good job at doing that. Every one of the administrations has done well, to the point that we now have 4 million more jobs than we have workers. There were 47 million people who quit their job last year to take a different job. Think about it. In our population, 47 million quits. And some may be multiple quits, who knows? But that's a record number of quits. People don't have to stay with the same job.
But recently we haven't seen those put pressure on prices. I mean, when I say prices, I mean employment. That's the reason why the Fed has been a little more dovish, is that they haven't seen wages rising because of that.
I think that's a good point and a really valid point.
But we don't know how long will that last. We don't know.
And we don't know how many of those 47 million people quit to go to a higher paying job.
We don't know that, right?
I mean, it's one thing to strike, and we've seen a few strikes happening to get higher wages. But if I want a higher wage, why not just step down the street?
But on top of that, Mike, we also talked about in previous shows more recently is, the supply chain moving back in this Buy America, right? As we mentioned in our previous show, Buy America is a lot easier to explain to people at a town meeting than the intricacies of global trade and how that's going to keep prices down, right? And we're addicted to cheap prices.
Yeah.
With that happening, and as we all talked about, this protectionism and tariffs and things going on, who knows how long the cycle could last?
It can last a decade.
Yeah.
It can last longer than a decade.
And we've gone through these before. If you look at the history of tariffs and protectionism all the way back since right after the Revolutionary War, we talked about an example with John Adams, which cost him his election because of tariffs.
Yeah.
And we've gone through Smoot-Hawley in the 30s, so we've seen this before. In the 70s, with the steel, and then in 2000s again with the steel, right? And so we've seen this before, and it doesn't work.
Yeah. And for all the predictions of a recession, we're not seeing that.
Like we've said, we saw it in October and November and December of last year was the recession.
But what we also saw is GDP in the fourth quarter grew at 2.9%. That's faster than it's been growing.
Yep.
And wages increased 5%, so they just kept pace with inflation. Mm-hmm. People are at a standstill. They're not gaining. So that's where we are right now. And we think that's a real change. And we think that is reflected in the stock market beginning on October the 12th, 2022. Which brings us to 3 indicators that say we saw a bottom on October 12th, 2022. Talk about that because you want to be aware of that. We talk about the January effect.
Mm-hmm. If we're up, according to the Stock Traders Almanac, if you're up the first 5 days of January, you got an 83.3% chance of being up for the year.
Yep.
In the following year, because an election year tends to be the best year in the market.
And the second best year is the third year of a presidential term. Mm-hmm. Because they've implemented all the things they were going to do in the first couple of years, and they're having an impact. Mm-hmm. So we saw that. We saw that the market had recovered 37% of the drop from October 12th to January 12th. And we saw that happen. And that's an important thing because it's something we've talked before, is the Renshaw study. Edward Renshaw, the University of New York of Albany, looked at all the times between 1872 and 1990 when the market had dropped anywhere from 5% to 40%, all the times from the Civil War time. And it happened 42 times. That's quite a few. 29 of those happened during recessions or depressions. 13 happened during good times. Think about 1987. That was a good time. Think about 2020. That was a good time. Either good economic times or recessionary times, depression times. The recovery has been similar in every one of those times. And I added, because the study ended in 1990, I added 2000, 2008, and 2020.
Yeah, because he passed away. It looks like his study went all the way to 1990, just 90, right? Is when he stopped his study. Yeah. So he wouldn't have the the last 30-something years of data.
So, every time the market recovered a third of what it lost, the market continued to rally. We saw the bottom. I've been wrong a couple times. In 2008, in November, I thought the market had bottomed. Turned out 90 days later, we weren't up 33%. Last year, in June, I thought the market had bottomed. 90 days later, we hit a new bottom. But this time, the market is up 37% from October 12th to January 12th. That's happened now, prior to this time, 45 out of 45 times. My bet is that this will be the 46th time. And if this is the market moving up, it means people need to really figure out if you're going to hold them or if you're going to fold them and walk away.
I think a lot of people did walk away, Mike. We talked about this week that annuity sales were off the charts.
Yeah.
Better than 2008. People putting money, and I don't know if it was investable assets they were moving to annuities or if it was just, their safe money. I don't know.
But it's time to find a new financial advisor. That's what we're talking about. And if you look at the market, the Standard & Poor's was up 37%. We were up 47%. And I think there's reasons for that. And we're going to come back and talk about that right after this commercial break. So don't go away. When to run? Yes, indeed. That is the theme for today. I received a letter yesterday from a competitor. And actually, if this program is playing again, the letter came just shortly after I wrote a newsletter. It's our main competitor at The Money Show, who has a model, a rules-based investing, in which he tries to sell clients that his model works very well. And this is what he wrote to me. I'm going to read just parts of it. It's dead wrong. Let me first say that. It's dead wrong. And I'll get to that because I'll share some of my response as well. But he wrote, "Dear Mike, many, maybe most investors want to know the past performance of an advisory firm's investment track record." I agree with that. "Seems like a simple request. But due to the SEC, the Securities and Exchange Commission, 460-page marketing rule, distributing performance data on portfolio models where clients are managed uniquely is not permitted." That's a statement. Where clients are managed uniquely and where you're looking at the performance data on the model, you can't put the individual clients. Either you do a composite of the clients or you do the model, but you can't do both. And the bottom line on this, I will tell you, he needs to read the advertising rule. I read the 460 pages just as soon as it came out because I was really interested because it includes, you can do testimonials, and it lays out the rules for how you can post a composite of your client performance, which is what we do. And we've been doing since 2005. We met all the requirements. I have to say that he used to publish his results with a disclaimer model saying that actual client returns could be different than the model because they started at a different time or because they had different objectives. You know what? If you look at our performance data, you'll see that anyone of our equity clients, our stock holding clients, anyone who started with more than one quarter results is included. Anyone that terminates, their account was included in the past data. Anyone whose account changes for whatever reason, if they suddenly move from being a regular IRA to a Roth IRA and converting, we pick up the old data and continue it through the future. And we've seen this with some of the reports that have opened where someone has a bad performance and the advisor talks them into opening a different account so they can start the results different. We don't do that. If someone were to do that, we would pick up the old data. But there's a big push in his presentation on the website about his performance, and then all that disappeared. And in my opinion, the regulators probably came in and visited. But I'm getting beyond myself. Now, he goes on to say if our portfolios were structured as ETFs or funds, we could do that, but they're not. Portfolio models like his tactical growth model or diversified income model is not a fund. And so each client's account depends upon the size, the deposits, the withdrawals, and so on. He said, you can't do that. He's wrong. And then he goes on to talk about the Tour de France. And I won't take you through that, but he has this perverted story about why, if you wanted to buy a bicycle for the Tour de France. But let me say, this is how he closed. In closing, let me share a situation with you. Right now, we have clients that are up more than 13% since July of last year in our model. Now remember, I'm claiming since October 12th, we're up 47%. As a side note, 13% is not as good as the Standard & Poor's, which is up 37%. And I'm sure he's hearing from some of his clients, and especially since we have an overlap at the Money Show, and a number of his clients, I would guess, are getting our newsletter that shows those results. That we're up 47, the S&P is up 37, and he's up 13? This was, of course, during one of the worst periods of the market, he goes on to say. I would love to tell you which model, and I would love to tell you why that model is up over 13%, but I cannot. Why, you may ask? Well, there's 3 reasons. Number 1, it's against the SEC marketing rule to report average or simulated trading results as actual results of real trade. No question, that's true. But what you're seeing in the AFC accounts are real trades and real results. They're not simulated, they're not average, they're actual. Secondly, he says, past performance is not indicative of future results. Just because we made 13% in the last 6 or 7 months for our clients is absolutely no reason to think that we will do that good or worse or better in the next 6 to 7 months. I agree with that completely. But we're not talking about a track record of a lot longer time, and we'll talk about the very short period of time which I picked. We'll come to that. And thirdly, he says, no 2 clients following the model portfolio will have exactly the same results for a host of reasons. I cannot report one client's return and guarantee that 100% of all clients following that model portfolio will have exactly the same results to the penny, because all of his clients are managed uniquely. His bottom line, T Capital, along with all other firms that manage client assets uniquely, cannot advertise or distribute historical returns as indicative of the trading activities they do for their client. My bottom line is, number 1, he's not read the advertising rule. He was in violation when he was reporting model results. I looked at his results. Second, he's up 13% since July. He's trailing the S&P 500. Third, some of his clients probably get my newsletter because we're both present at the Money Show. And fourth, our clients are up a lot more. I drafted a response. I haven't sent it yet. I want to review it. But I said, thanks for the long letter. You have to put a lot of thought into it. Thanks for pointing out that in our last newsletter, I didn't spell out the reasoning behind the performance number related. And I will get to that later on in this letter. And I said, I'm not sure you've read the advertising rule. I did when it was first released. I was quoted in the weekly compliance bulletin put out by IA Compliance. I really like the rule. I know you manage using a model. We don't. Every one of our accounts is designed with a client risk and reward tolerance in mind. Every one of our clients is different. Every single client is different. We have conservative clients, we have moderate clients, we have aggressive clients. But when I started Adams Financial Concepts in 2005, I contracted with Advent, a company, to monitor and quarterly report every client's performance. I terminated that when I discovered mistakes in their calculations, and I went to Morningstar. And up until recently, Morningstar was daily monitoring every client's account, looking at what was added, what was subtracted, what the trades were on, and doing a performance report every month. At the end of last year, we switched to a company called Advizon. And I point out, secondly, I decided not to make our portfolios composite of GIPS, what's called GIPS compliant. And I pointed out, as an engineer, he would understand why I wasn't doing that. Number 1, GIPS requires, when you're doing an individual client portfolio, to use a time-weighted return. And when you're doing a composite, to use the internal rate of return. I feel both of those are just the opposite of what happens. With time-weighted returns, when you have a significant addition or subtraction of cash into an account, it can truly affect the return. And the example I use for him is if someone puts in $100,000 and the account increases 50% to $150,000 at the end of 1 year, up 50%. Client's really happy about that. He puts in $1 million. He now has $1 million and plus $150,000 that he originally put in. But this time the account drops 20%. Instead of going up, it goes down. So what the client is left with is $920,000. He put in $1.1 million. He's $920,000. If you look at the time-weighted return, you multiply the 50% by the minus 20%, and you come up with the account being up 20%. So if you take the $1.1 million and take the 20%, the account should be worth $1.3 million. But wait a minute, it's worth only $920,000. The fact is, if you use an internal rate of return, the actual performance is down 4%. Not if you use time-weighted return, it's up 9.5%. I decided at the beginning when I was doing our accounts that I would use the internal rate of return. Sadly, neither Advent or Morningstar uses the internal rate of return. They both use time-weighted return, so I was locked into that. I couldn't find anyone else that used the internal rate of return until Advizon came along. So from here on, we'll be using Advizon to do internal rate of returns, which are more accurate for client accounts. The second thing is GIPS does use internal rate of return for combining accounts into a composite. The issue with that is that big accounts get heavily weighted. Small accounts never get weighted very much. So it favors the big accounts. And when I talked to the GIPS people, and I spent a fair amount of time investigating this, when I talked to them, I said, I want something where everybody is equally weighted. You shouldn't get paid more for a big account than for a small account. You shouldn't put more effort into it. You shouldn't be rewarded for having a better return in the big account. They said, well, it comes down to the fiduciary. You have to make every decision in the best interest of the client. I said, the reward is for the big accounts, you do better. No. With a time-weighted return, a $10 million account counts the very same as a $5,000 account. Think about that. It's not the size of the account that counts. It's the management that counts. That's what we have chosen to do. We are not GIPS compliant. We will never be GIPS compliant unless they change their method of calculation. And that's by choice. That's by choice. Now there's more to it, and I'll get back to that right after this commercial break. Don't go away. Know when to run, actually. It is a time to do that. And I started talking about my response. I want to continue my response because I think it's important for you to understand. Because I responded, if this competitor had read the advertising rule, he would know that it covered composites of client accounts. I was and have been since 2005 in compliance with the reporting of our client accounts. I don't use a model. Those are actual client accounts with no carve-outs. As soon as a new account has been with AFC a full quarter, it's in the composite. And accounts remain in the composite until an account is terminated, which sometimes happens in the case of death or a client terminating a relationship, and we've had a few of those, not many. We've had those. The number of accounts in 2022 in the fourth quarter composite was 143. It wasn't a single account. It wasn't carving anything out. And that compared to 112 in 2020 fourth quarter. Of those 112 in 2020, 111, all but one account had a return in excess of the Standard & Poor's 500. All but one had outperformed the Standard & Poor's 500. We even say in the document, the agreement we sign with clients, our goal is to outperform the Standard & Poor's 500. That's written, that's signed, we sign it, the client signs it. And I've been managing those accounts in 2020 for over 16 years. So some had a track record of 16 years, some had a track record as short as 1 month, and they were all above. Now, I can't say that today after what went through 2022, and I didn't look at it. Maybe I had a psychological block. I didn't want to look at it. I'll look at it again soon. But the performance is net of all fees and all expenses. And that's the requirement of the advertising rule. And it says you have to have the performance for the past year, for the past 2 years, for the past 5 years, and 10 years. We do ours with 1, 2, 3, 5, 7, and 10, and since inception. That's more than the advertising rule asks for. And I've been tracking client performance since the beginning in 2005. When the market hit a bottom in March of 2009, I said, this is really a change. We began to track a separate set of performance from 2009 onward. We still publish the 2005, we published the 2009, but we will start beginning with the first quarter. We'll publish 2 quarters of data, and we'll continue to expand on that because we think the market bottomed in October of 2022, and we think that things are going to be very different going forward. We think there's a reason for people to look at their current accounts and switch. If you look at the accounts in 2020 that were above the S&P 500, everybody was. But the accounts that started with us in 2009 and 2010 were a little better. There's a convergence and they get closer and closer together. But the ones who bought low had better returns, especially in the beginning. We believe that inflation is here for another decade, and we think that stocks do not do well. We think there's going to be a big disparity between stocks. There's going to be some that do extremely well and some that do poorly. We want to be in the ones that do well. We don't want to be in those that do poorly, and I'm sure that we'll end up in some of those. No matter of what we try, we're not perfect, and we don't have a crystal ball, and sometimes things go wrong in companies. But our focus is to find those focused companies, concentrated portfolios where we can hold on to the stock for a very long term, and where we think that stock can do very well. We're not in the FANG stocks. We've never been in the FANG stocks. We look for something beyond that. We look for something where companies have something special in either technology or demographics or lifestyle. We think those things have really changed, and they're going to continue to change during this time. And if anything, a high rate of inflation, high interest rates are going to continue to make that disparity between good and poor performing stocks ever greater. It happened during the 1960s. It happened during the 1970s when we had inflation. And when I say some, it wasn't a good portion. It wasn't a majority. It was a few stocks that outperformed and doubled or tripled or quintupled or grew tenfold. We've talked about some of those. The McDonald's, who came public in 1966 when the market reached 1,000, and it didn't reach 1,000 again for another 16 years. McDonald's did well. Walmart. You can go down the list of those companies. Arrow Electronics. And go down the list of those companies which did very, very well during inflationary periods of time. But did 500? No. Was it 20? Was it 30? Probably. Did 400 suffer along? 400 maybe suffered along, and maybe of those 400, 100 did okay and carried the rest along. But we think the market is on its recovery time frame, and we want to track it specifically, and we want to track every specific account. And we compile that into a composite and look forward to see how we're doing going forward. And past performance doesn't guarantee the future results, but you know what? We stand on our track record. It's published. It's there for everybody to see. It meets all the requirements of the advertising rule on what the regulators are asking for. It's done on a time-weighted basis so that large accounts get the same weighting as small accounts, or vice versa. Small accounts count just as much as large accounts. Al opens accounts for 100,000 above. My minimum is above that, but you can open an account for that. And we would recommend now is a great time to do that. I go back to this letter that was written. Most advisors do not want to publish the results. And you got to ask the question, why? I think our competitor answered the question. He's up 13%. He was really proud of 13%.
Well, most of them are just pushing asset allocation.
Yep.
That's you got to be diversified all over the board.
Yep.
And that's the selling point.
And give him credit. He's up 13%, and most people are down. But he's not up 47%. And the stock market is a very humbling time. We got very humbled during 2022. Very, very humbled. We had big heads and huge egos in 2020 when we were up 77%. 2019, we were up 40%. We got humbled in 2022. But we stand on our track record. That's where we stand. We think there's a time to hold them. There's a time to fold them. And if you're not with us, you really have to think about folding them and walking away. And I say there's a time to run. And we've seen several clients who have moved to us who were involved in a scam. That's really the time to run. If you don't have all your information, and if you're not getting all the information, or if you think you're getting false information, it's really a time to think about running. But that's a whole different story. We just want to talk to those who know that it's time to fold them and walk away. And that wraps us up for this week. Any last words, Al?
No, the song tells the story the best, right?
It does. Know when to hold them. Know when to fold them. Know when to walk away. Know when to run. And if I had a voice, I would sing it. But that would probably get people to turn off the radio. Have a great week and a great weekend. We'll be back next week to talk about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.